What's going on, everybody? Welcome back. Grab a pen and jot this down. Today we're going to talk specifically about how to invest in alpha. This is a really exciting topic for me. It's something that I look for very closely. I think it's easier to do than what seems on the surface level. It's a very important metric and an indicator that Warren Buffett has been using for 10, 20, 30 plus years, that he's personally talked about in his shareholder letters for decades. And the reality is, when you look at the S&P 500, the Russell 2000 index, you have an opportunity to invest in the broad market index, which is great. It's very low cost. It makes a lot of sense for most investors. I think everybody should be looking to have that type of exposure because 500 stocks, 2000 stocks, the reality is if you have a portfolio of 30 or more stocks invested across multiple industries, in this case, the S&P 500 has 11 industries. You are very well diversified. 5-10% moves in single stock names are really not going to impact you over the long run. You're going to capture a lot of the long-term compounding effects of being invested in a very broad set of names. S&P 500 is very popular for this. It just happens to be the most popular vehicle because it's the largest market cap names. So that's fine. Fortunately, for most retail investors and even institutional investors like pension funds and endowments that manage retirement money, buying into the index has become so cheap that it's almost zero, if not zero in most cases, with these new software products, financial software products. So like Vanguard, State Street, iShares, all these guys offer some form of variation of how to buy the S&P 500. So that's great. 500 stocks, amazing. So what's happening is that you have an opportunity to get exposure to all 500. The problem is you're really buying a mix of good, bad, and ugly. You just don't know which ones are which because you're just not, putting in the effort to say, how do I reduce my exposure from the 500, get rid of the 490, 450 bad stocks, and then in this case you have to set a really high screener and you say, what should be the barriers to entry into my portfolio to deliver very high performance? Warren Buffett has a very simple metric, and it's so simple that you would overlook it. So to start from the beginning, he's been averaging 20 to 25% average compounded returns for multiple decades. The reason is because he looks at the return on equity, which is the variable driver in this case, and says it has to be 20%. If it ever drops below 15%, the company doesn't have the staying power to compound cash flow at the level that I need it to, and in his case, he definitely needs it to. So there's a problem in cycles, in different environments, maybe competition, maybe economics, maybe interest rates, maybe a variety of changes. So if a company can produce over 15% return on equity, because you're buying stock, that's an equity capital, you're buying equity shares, so you have an equitable interest in the company, literally dollar for dollar. If the company can deliver 15, preferably 20% return on equity, that means over the long run, 5, 10 plus 15 years, you will actually earn 15, 20 plus percent plus capital appreciation on the valuation. So the company's compounding equity at that level, investors are going to eventually chase those returns, and eventually the company becomes so powerful, so big, so profitable that everybody will get a piece of that, and then your equity actually will appreciate greater than the 15-20%. So you can use that as your primary driver to identify alpha. You'll find of the 500 stocks, maybe 50, 60 of them really have the level of performance, outperformance, high performance that you're looking for in a really good company. And in this case, the very easy metric, everything else boils down to it. The company has to be very profitable. It has to be well run. It has to have a long history of doing very well, operating very efficiently. So all those metrics boil down. And if you are an investor looking to buy equity in stocks as opposed to debt and fixed income and other instruments, return on equity with the 20% threshold is the best indicator to figure out if you're investing in alpha or not.